Okay, we are 4 minutes past time, so I think we'll kick off now. So welcome everybody. I think we've got one more deciding whether it's Nick's going to join us or not. He is going to join us. So welcome everybody. My name's Andrew Bowl and I'm Chair of the Organising Committee for ICA2023. So welcome and hope you're having a good conference so far. This is, just to make sure you're in the right room, and this is, and hopefully you are, Concurrent Block 4, and this is about student loans and pension drawdown. We have 2 sessions today to go through, so and then we'll have a Q&A session at the end of each. So please ask questions as we go along in the usual way that you've been used to throughout the day. Before we kick off, I would like to just thank our platinum sponsors in particular, RGA, Milliman and Accurate for their support, and all the other sponsors as well, but particularly our platinum sponsors for their support. It's an interesting, I was in one of the demographic sessions earlier today, which Nick was chairing, and Neil Howe was talking about the demographics of the world. And I was just thinking about the international, there's an intergenerational equity between funding various activities. And one of those, I was in this fortunate window in Australia where the Whitlam government in 1974 got rid of tuition fees and they had free university education until 1989. And I was in that window. But then HECS fees were reintroduced back into to fund education for higher education in Australia from 1989 onwards. And that was in 1989. 1992, we had the compulsory superannuation guarantee introduced at 3%. It got to 9% in 2002 and is heading to 12% by 2025. And so we're going through this process of passing risk from society across to the individual. So now you can pay for your own education and pay for your own retirement. And so there's, I'm trying to find the link between these 2 papers. So hopefully we can discuss how we go through funding education. And one of the interesting issues that Neil Howe brought up, though, was just around with falling fertility rates and shrinking workforces, how society will choose what's the most important things to fund, whether it is education, whether it's childcare, or whether it's retirement. So they're interesting challenges for all to face. So I'm looking forward to the 2 papers today. First of all, we'll have Masaaki Shigehara from Japan. He works mainly at works at Daiichi Life, mainly in pricing, reserving, demutualisation and accounting standards. And his main research areas are insurance regulation, social security, risk management and life and health insurance products. And then following that, we will then have Ben Hillier, who's General Manager of Retirement Solutions at AMP. He was also the Principal Architect of the Q Super Lifetime Pension and the recently released product at AMP. He'll also be joined online by Anup Varghese, who's the Head of Hedging Strategy, Pricing and Modelling at AMP and worked on developing and managing capital preservation, retirement and liability-driven investment strategies at AMP. So we'll kick off now and welcome Masaaki to the podium.
Thanks for the introduction and thanks for coming to this room. I'll talk about the financial forecasting of the student loan scheme. New type student loan with income-contingent repayment are now born in this Australia and now expanding in the world. I will talk about this new type scheme of student loan from the actuarial perspective. This is the outline. First, I will explain the income contingent loan in the world. Then I will look at the existing model on them and its problem mentioned. I thought to solve some problems mentioned, the old actuarial method to say portfolio view might be useful. It also shows the analogy of the ICL and defined benefit pension scheme. Next, I will show a simple ICL model system and make a financial forecasting based on the portfolio view. I will then mention about future challenge to go on this way. I feel it is a trial to extend actuarial fees. So after all, I will suggest the feature suitable for actuarial new field. So first, what is income contingent student loan. ICL is a kind of student loan with its repayment after graduate are related to his or her income or earnings. More money graduate earns, more money is repaid. Less money earning graduates repay less money, so it is easier to repay than fixed repayment student loan. Note that less income does not decrease the residual loan amount, it is only postponed. The ICL is expanding. It is used as the compensation of the start of tuition fee collection. The loan, easy to repay, is helpful for national budget or taxpayer. It is also seen as a way to extend the opportunity to have high-level educations for young, especially poor young persons. ICL system is various. Written in the slide are the typical feature. Payment or loan amount is generally fixed, such as tuition fee only. Loan may have variable interest. Repayment is defined as a certain portion of the income or earnings. I would say only income for convenience. Generally, some threshold is set at, and if the income is under it, the repayment is postponed. Note that it is not cancelled. The residual loan is set still and interest may be added. To easier and fair collection, sometimes tax system is used to collect the repayments. Repayment ends by paying all the principal and the interest, death or disability, and sometimes coming to certain retirement age. The latter two cases, there may be some residual. It would be compensated by tax or other funds. The cash flow of the ICL system is similar to that of DB pension fund. Both collect certain portion of income. The greatest difference between two is the timing of the benefit. In ICL, students get the money in advance. DB members get their pension benefit after their retirement. Thus, ICL can be seen as a kind of reverse pension. But the model used for the ICL systems are different from that of the defined benefit pension. It is a hero model used for the UK ICL forecasting. It is basically stochastic model for individual. It sets many types of individuals, age, gender, degree type, are set to resemble real figure of student. Then the model forecasts for each model persons individually. Macro parameters are used to set stochastic scenario, but it simulates each model persons independently. Hero model improved the forecasting on ICL, but it has still some point to be improved. UK National Audit Office had made a report on the ICL system in 2013. It points out that the hero model still over-forecasts repayments constantly, and pointed out the issues what might be seen as the reason. After the report, the forecasting systems have improved. For example, subject studies are considered in new system, but the basic structure, individual forecasting and aggregation is still not changed. So, if you make the forecasting model of ICL, what would you do? Many actuaries might consider the portfolio of loans and repairs. I do so. The slide is the portfolio model for ICL I considered. On the graduation, new repair comes into the portfolio. Portfolio members get income and pay repayments. Mean income divided by ages draws the income growth curve. Portfolio members go out from the portfolio by 3 reasons: payout, aged, and death or disabled. Residual loan at age, death, or disabled is assumed to be compensated by the government and off from loan portfolio, so this model assumes. But there is a problem. Some parameters, like new repairs, income growth curve, age, and death numbers are directly observable. But total graduate income times repayment rate does not become repayment amount. It is partly because of income threshold and partly because of the persons fully repaid the loan earlier. I call them early paid persons. Early paid persons get income but not repay more. So some adjustment factor is required. I named it as S factor. It takes long time to get S factor from the experience. So S factor must be set on some other way, like stochastic simulation. Also, I changed the portfolio from repaying person's portfolio to all living graduates. One of the reasons is the past dependency of the repayments. Portfolio model does not have the past information. Other reason is the income curve. Richer persons tend to go to early payout, so the less portfolio has different income curve than from total graduates one. So it is difficult to observe. Then make the portfolio-based model on the simple ICL example. I set the example simply, but I intend to have some the model sub-reality. This is the definition of the model ICL system. The system starts at year 0. Each year, 10,000 new borrowers graduate. Loan amount is 50,000 per person, and repayment is set 7% of income over threshold, 20,000. Retirement age is set at age 60. The interest rate, income increase rate at each same age, and loan principal increase rates are all set to 0. In other words, it considers all on present value basis. For the income transition, there exists some T-copier-based model, but for simplicity, on this model, I set the transition matrix. It is said that volatility of individual income level increase within coming 20 years. This is the formula of total portfolio model. First, S factor is set by cohort stochastic simulation. Using S factor, portfolio simulations are made cohort by cohort and aggregated. So the model is done, then what was found? This is a S factor graph. S factor is divided to two elements. One comes from threshold. Another is from early payouts. In this case, till age 36, there is only threshold element, and S factor decreases with age increase due to income increase. After age 36, early payout starts and S factor increases. The volatility change does not, S factor increases, so sorry. The volatility change does not affect so much on the S factor in this case. This is the result of the first cohort. Income amount increased along to the income growth. But due to the increase of S factor, after age 36, total repayment amount turned to decrease. On the retirement age, about 10% of loan principal is not refunded. The mortality does not have much financial effect in this case. And this is the forecast of the total portfolio from the start of the ICL system. About 20 years after the scheme begins, the portfolio comes to nearly steady state. We have seen the example of the portfolio model results. Now let's consider the pros and cons of portfolio model on ICL system. For pros, I raised 3 points. One, less parameter. Packaging past-dependent elements to S factor and analyze it beforehand, we can avoid to consider the parameters of less importance. Two, relation to the macro experiences. Actual to expected analysis can be easily done. Three, easy to modify. One con is that portfolio model cannot consider individual circumstances. For example, to know whether the change of ICL system helped the relatively poor persons, it seems difficult to use portfolio model. Two, granular analysis. Doing granular analysis might kill the pros of the portfolio-based model. And another con is the determination of S factors. We will return on it. The model I made is a very simple model. There are many things to be done. There are many challenges left on portfolio model. This slide shows the challenges within the model itself. S factor cannot be easily set. The graph is S factors with several conditions. The difference is not so simple. Reflection of personal differences has some problem itself. As mentioned, more granular class would make the result reliable, but it might harm the merit of portfolio model, simplicity, or so on. And there are challenges of the usage of the model. For considering suitable accumulation method for future compensation, defined benefit accumulation method might be referable. Inclusion of conservative margin or scenario setting of various purposes is another problem. Relation to real-world data or experience, analysis like actual to expected analysis by its source, and communication about results are also challenges. I want to be solved by actuaries like you. At last, I will comment about actuarial new world. Traditional actuarial field generally has such a feature, I think, portfolio-based relationship to the real world, long-term, and proportional principle with professional decision. The field with this feature might be an actuarial new field, I think. I hope many actuaries will try to develop new fields. I wrote this paper before I know the IAA publishes actuarial new field about. So I recommend to read the papers also. So this is my presentation. Thanks for listening.
Thank you. Are there any questions I think we're having a bit of trouble with the app, so if you've been putting questions through, they haven't come through to me yet, so we might have a microphone at the back, do we, for people to ask questions if you have some questions you'd like to ask from the floor. Just raise your hand and we'll get a microphone to you.
Thank you very much for your great presentation. I have a question. It is very important from the perspective of ESG, and actually should contribute to the ESG program as a professional. What about your opinion from the ESG side, ESG prospect, please?
I generally agree with it. Actually, we should consider the ESG matters. For the for this method, portfolio method, it does not suitable for considering each person's circumstances. So it is such a purpose. For such purpose, it is not used, I think. But the forecasting of the ICL system is itself important for ESG perspective. So the method can contribute to the ESG. Wait.
Okay, any other questions? Yes, thanks, Steve.
Thank you for your excellent presentation of your model. Can I point out 4 factors that are observable from Australia? And I should say that I am in the university system here. The first issue is that not every graduate earns enough money in the first few years in order to break through the income threshold before they start their repayments. You need to estimate how long that takes. And for example, there are 2 professions dominated by women, teaching and nursing, where many of those graduates maybe never get to the income threshold. Secondly, Australians tend to work overseas, and the model, both in Australia and in your model, is dependent on collecting repayments through the tax system. If you don't earn enough income, which I've already mentioned, or you don't earn income in Australia, you're not exposed to the risk of repayment. Thirdly, there is a differential tax rate applied depending on your income strata. And fourthly, there is an issue with respect to accumulating debt, not just through this system, but other debts, for example, mortgage for a home and so on. You need to add that into the ability to repay. So you find in the Australian system, which other people have tried to model and copy, that there's about a 20% bad debt rate as a result of those 4 factors. So the model needs a little bit more modeling.
Thanks. I know the Australian system is very, to say, complicated. So I set a simple model for this report to show the portfolio-based forecasting only, so forecasting way. So it is very not the real. Before you mentioned before the problems you mentioned, there is a difference in the graduate age. So different graduate, how to treat the different graduate age is a first problem, I think. So the teaching or nursing problem or overseas problem and differential tax and mortgage, so on, is the problems left eye knows. So I would consider, but other people may consider about them. I hope.
And it's interesting, there's the interest rate used by the government often doesn't change as quickly as the banks change their mortgage rates. And so when you have to repay, can you repay early or not? It depends on whether it's, if you've got a mortgage, and which one's the where you want to divert your funds as well. So there's lots of complications come into it.
First of June is the most important date in the year. And to be fair, it allows low-income people to go to university.
Are there any other questions? We've got a couple of minutes left before we move on to the next presentation.